Let me welcome to the podium Huang Yiping, Dan Rosen, Liang, and Xiang Songzuo. The theory of how we organize these panels was the first panel was going, the two keynotes were talking about the economy generally. The first panel was talking about kind of China's economy as it developed, and this one is supposed to talk about the risks and the opportunities in China's economy. So let me start with exactly the topic and start with Yiping. You have their titles, so I won't use our time and repeat them. What do you think, I'll go down the table, what is the biggest risk to China's economy going forward?
Well, everybody is talking about high leverage, but I do think financial risk, what we call systemic financial risk, is something that we should watch very closely. And that could be a very wide range. High leverage is one thing, but I agree very much to what Mr. Qing said earlier at the beginning. Leverage ratio is very high, but the probability of Minsky moment, imminent Minsky moment, is not very high. You just look at the leverage ratio at the aggregate level. It's a relatively high number, but it's really high for the corporate leverage. And within the corporate sector, the state sector leverage is rising and the non-state sector leverage is actually deleveraging. So I would put a lot of attention on the financial sector, but high leverage is not something I would lose sleep overnight today.
What's the debt to GDP ratio?
That GDP ratio, depending on which measure you look at, but if we're looking at the corporate debt, it's about 160% of GDP. It's relatively high. But you look at the state versus non-state, it's a completely different story. So I think in my view, the greatest risk is probably where regulation is not fully covered for these financial activities, so the shadow banks, fintech activities, and so on. Again, Mr. Qing mentioned earlier on, the government already put together a new institution trying to extend the full coverage of regulation for all these activities. So risk is everywhere, but to me, a major financial crisis looks very unlikely.
Huang, what do you think? So we'll put what's the second, because that's going to be everybody's answer. What's the second biggest risk then? if you think that the financial, the debt to GDP is the biggest risk, what's the second biggest risk?
I don't think that's the biggest risk. So,
it's going to be harder and harder as we go down the table.
Every economist differs somewhat. I think for China, the last 4 decades, it has been growing, as Professor Lin said, average 9.6%. The financial system was not the obstacle for growth, despite its massive inefficiencies. Will that become an obstacle in the coming years, particularly when China tries to open up capital accounts in RMB internationalization? In that process, some of the controls that shield the Chinese economy and the financial system from some of the shocks and risks, once that gate started to be opening, how the current very backward financial institutions and system, how that would adjust to this opening up process. I think that's something I don't think even some of the policymakers...
So the risk in transition.
In actually further opening up and reform, actually not keeping the status quo. And I think there's no roadmap for how China could do that. They built a number one manufacturer powerhouse, but if you look at the financial institutions, they are very still state-owned. They have never been to really subject to competition, even domestically. But once they started that process, and the government seems to be very ambitious about it, I think that in the last 2 years, we have seen a stock market crash, but also the currency was not properly managed when they tried to give it more flexibility. So I think that's a new challenge. I think, as Professor Liang says, we're expecting a lot of changes and reform. I think that GDP ratio, I think that the government started to undertaking efforts to address that. And I think we have reasonable confidence they could deal with the stock of the problem. But some of the ambition of opening up the financial sector, I don't think the roadmap and some of the issues are carefully thought out.
Do you think the recent announcement of opening to foreign commercial banks, investment banks, and credit rating agencies increases, is neutral, or decreases risk in the Chinese financial system?
I think they're irrelevant.
Irrelevant.
Because they're too small. Just look at the Chinese stock market. If they open up the gate, like they allow foreign participation to be like so far 2%, that doesn't really change how price discovery is done and how resource allocation is done. I think at this stage, if we look at some of this opening, especially I think financial sector is a non-tradable sector, very much subject to domestic regulations. I think one of the features we have never seen a financial system that's every major player, especially the banks, are still 70% owned by the state. Is it everywhere we worry about too large to fail for financial institutions, but for China, they're too state-owned to fail. And we haven't seen roadmap of how that ownership potentially reform vis-a-vis price discovery, making that process, how that is going to be taking off. So last 2 years, put it this way, we have seen some of quite bold financial liberalization, deregulation efforts, and that has created certain mess or chaos in pockets of the financial system. For the time being, we're seeing a bit more getting back the control, cleaning up the messes. But I do think in going forward, next 5-10 years, for China, the ambition to get to the next income level, financial sector reform, liberalization probably have to be part of the package, and that involves a process we haven't seen before. And every country, developed or emerging market, that process is much more controversial than opening up trade or FDI.
All right, Dan, what do you think the biggest risk is?
And I think too, Steve, that if everybody not speaking turns off their mics, there'll be a lot less echo in the room, actually, and it'll be easier for people to hear. Is that better a little bit? Okay, good. Well, thank you. And first of all, it's an incredible honor to be an American up here with Dr. Xiang, Liang, and Huang, not to mention Justin Lin and Chen Xiao and others from the delegation. Thank you for having me back. You know, I think that the question for 2018 that so many people up here are talking about is, can the reform China intends be costless in terms of growth? We've had a number of people say that despite the deleveraging work that everyone agrees will be done in 2018, focused on the SOEs and local governments, as President Xi said from last August, was a near crisis priority for China, that despite that, everybody's raising their GDP projections for the country rather than lowering them. And the theory that people are putting out there is, well, the credit multiplier, the value, the contribution that new lending was making became so low for real economy output. It was just speculators loaning to speculators, loaning to speculators. So it wasn't really creating growth as this credit bubble was going up. And so now as we deleverage, it's not really going to have a cost. It's not going to take away from the investment component of GDP growth in 2018. Likewise, as Huang just said, we can open up to foreign competitors in the financial services space, and yet it's irrelevant. It doesn't have any effect on the conditions of competition in China or any macroeconomic outcomes for the country because they're too small to matter. Now, as the Citibanks of the world would say, we can actually be pretty major competitors when we're given a chance to truly compete. We can be non-trivial part of a country's financial sector. So, Steve, in my view, what I would say is no pain, no gain. If it's true that all of these reforms are costless in the GDP outlook at the macro level, or in terms of industry competition in the financial services industry or any other industry, then that means they're not really being permitted to change the incentives, to shake things up. And it's only by shaking things up that we get to the innovation, which Professor Lin just told us, we might want to change our whole model so we don't think just about GDP, but we think about innovation as the goal of policymaking. And again, no pain, no gain. And I'm hearing too much that, don't worry, there's not going to be any pain. That makes me nervous.
Xiang, go ahead. Last.
Yeah, then Dr. Liang and Dr. Huang also all mentioned financial risk as high leverage ratio. I agree with. However, I'd like to mention another major risk of Chinese economy as well as Chinese society, the social risks. I mean, for example, environmental deterioration, poverty, particular the productivity deterioration in agriculture. So that's why I understand the last December working conference of Communist Party set up the top 3 priorities of this year's work. First is, of course, contain the major risks, including financial risks, but not only financial risks. The second is reduce poverty, particular poverty in rural areas. The third is how to improve environment. For example, I just got a cold in Beijing before I came here. I have not yet recovered still. Because Beijing is so dry, Beijing has not snow or rain for at least half a year. So I think looking forward, of course, we must pay attention to financial risks, but as economists, I'd like to emphasize we should pay even more attention on social risks, particular environmental and poverty. Even more important than financial risks in the long term.
I think the 19th Party Congress document does do that.
Yeah.
I mean, I think there's a lot of attention paid to income inequality and social programs.
Because usually people talking risk, and they all means financial risks. But don't forget, there are so many other kind of risks, more important even.
Go ahead, Dan.
I just want to agree with that so strongly, and Xiang, ask you a question then, if I may. Environmental policy enforcement is very real right now. We've been tracking that at Rhodium, and we're quite impressed by how serious the environmental campaign is. It is nationwide, and it's having a big effect, not just on air quality in Beijing, but in a lot of places. But environmental policy enforcement brings financial pressure, doesn't it? It does reduce the local economic activity, which reduces fiscal outlook for local governments. So the two are connected in a profound way, it seems to me, that the more you push on the environmental priority, you create financial stress in the system. Is that a concern?
No, I don't think so. I think that's the two things can do simultaneously.
No
Contain
connection?
financial risks and improve environmental conditions.
Painless.
Of course, we must sacrifice the growth rate of GDP. And the documents of the speech of President Xi in the 19th Congress Party downgrade, to my understanding, downgrade the importance of growth rates of GDP. The upgrade emphasized the quality of economy.
How could China surprise, what might happen that China would surprise on the upside? That we have actually, I mean, we're talking about 6.7, to 7, the consensus closer to 6.7. What might occur that would create a surprise on the upside? Yiping?
Sure. When we talk to foreign investors and scholars, particularly during the past couple of months, there's been lots of discussion or concern about government messing around a bit too much in economic activities and so on. I don't want to make a judgment on that particular issue. I think that's very complicated. But what I think we often miss or we don't appreciate fully is the dynamism on the ground that is taking place in China. I was an economist, used to work for a financial company, and one thing I always felt many times is that macroeconomists were often more upbeat on the outlook of the Chinese economy than those people who look at the micro level, equity analysts and so on. Because they often would complain that companies are suffering, but economists still put down a relatively upbeat number on GDP growth. To some extent, that was true. I can tell you, and my colleagues may be able or may not be able to confirm with you, this time it's actually quite the opposite. Economists are all talking about the difficulties and the pressure on growth and so on. But if you travel around the country, you actually see a lot more starting and rising companies, not only in the new economy, the internet plus companies, fintech companies, the robots, AI, and so on. But you look at the traditional companies, the large machinery equipment, household appliances, even some of the construction equipment and so on, you actually see all these companies rising, very dynamic, start to create some brand names. So I think if there's any one area I have to predict that could surprise the world, is that very soon China might actually look very different in terms of the corporate world.
Dr. Liang.
I think being an observer on China is fascinating. 4 or 5 years can be a long time. Dan just said, no pain, no gain. I think the hardest part I find for investors, especially external investors, to acknowledge is maybe 6.5% growth in China is already pain. 6.5% growth is recession in China. China had deflation since 2012 until 2016. 53 months of PPI being negative, and 2016 GDP deflator outright negative. So its growth rate in real terms came down half, nominal half. So it's already a lot of pain. So if I have a central rate of 0 for the US, in China, that is still 6.5 or close to 7. And so what can surprise people, like in the last 4 or 5 years, a lot of changes have happened in China. First, in the old industry, the last panel talked about the steel industry. But do you know steel companies, the ones that can operate today, are extremely profitable? If you have the right and capital to set up a steel mill today, in 3 to 4 months, you recoup all your capital. That's how high the returns are. The coal company, the same. The traditional industry people thought were dead are extremely profitable. So industry consolidation, capacity elimination has gone a long way. 53 months of negative PPI deflation has washed out a lot of uncompetitive producers. So manufacturing consolidation in the old industry has gone much further than many people outside acknowledge or know. But secondly, I think the area that surprised people start to see is manufacturing upgrade. So Chinese goods made in China being cheap and bad quality is just being transformed to be cheap and good. Good quality, good design. And that takes time for investors, for customers to really learn that. But I think the third one that is really amazing and that gets us excited is finally we see the rise of Chinese consumers. Consumption being very resilient. So everybody said Chinese investment number coming down, but even during the last couple of years, retail sales has been constantly running at above 10%. And I think China is, whether it's, when it will become the largest economy, I think people have different projections, but I think it's on its way to become the largest consumer market. And I think that's when Professor Lin talks about it will be a win-win, the rise of China will be a win-win scenario for the world and for US-China relationship. I think it is really hinges on the rise of Chinese consumer demand and China increasingly being not just a producer, but also a consumer.
The question is implicit.
It's about upside surprises.
Dr. Liang, Huang is absolutely correct. The pain felt, the adjustment that's taken place in China in past decades is enormous and extraordinary. And China's growth is not an illusion, right? It's very tangible to anybody who spent any time at all looking at it. Tremendous amount of evidence of the product of adjustment and market activity and all that stuff in past years. I'm actually just talking about the topic up here, the 2018 outlook, and how we think about the math. So maybe we can do a round here and think it through. But the notion is from the stated position of China in coming out of 2017, 6.8% growth. Are we going sideways in terms of growth rates, down or up for the next couple years, for 2018, 2019? CICC just came out with the view that China's actually looking at going up, that the growth rates can be higher. Dr. Lin argues as well that theoretically the growth rates can be considerably higher. And yet, when I look at the expenditure components of what adds up to GDP, the first is investment levels. Will investment level, capital formation, actually grow even faster in 2018 than it did in the past couple of years? When my understanding of the deleveraging imperative that Beijing has set out, that President Xi has set out, I find it difficult to see how we're talking about even greater investment outlays, either government-directed, for example, in infrastructure, or private CapEx, of firms choosing to double down their amount of capital stock build-out in 2018. The other components, government spending. I'm quite concerned about the fiscal ability at the local level where most government spending needs to happen. Whether 2018 will be a year to grow what local government is doing in terms of fiscal outlays. We've had fiscal reform on the boards now for 5 years. We're told that it's about 3 years behind schedule, maybe 2020 by then we'll have a tax reform that can support a restructuring of fiscal activity at the local government level. The other two components, net exports. I think part of the Chinese optimistic upside story is about global recovery, U.S. stimulus. Isn't that going to boost Chinese growth? My concern is that we're underestimating the trade war potential that Dr. Lardy and others talked about on the previous panel. I think we have a really fraught situation in terms of global trade activity that could just as easily be negative for China in 2018 and perhaps hence even worse for America, but that's a different question. Then it's likely to be a big windfall of growth for China on the net export side. And that leaves finally consumption, where indeed the Chinese consumer has been the hero of the past couple years of GDP growth. My concern looking at 2017 is that most new lending activity in the economy is to the household sector. Households are growing their consumption based on debt to an extent never before seen. Alibaba, for example, is offering people 20,000 renminbi, easy sort of Macy's card. You know, you go in at the holidays and they say, free credit card, no payments due for 6 months. Well, that's what's being done in e-commerce in China, you know, to a new order of magnitude, which is probably a good thing to empower Chinese household consumption, but it is very much debt-based. And then Ali is taking those household debt obligations, bundling them up into ABS and selling them into the interbank market and elsewhere, which presents new risks. So I just don't know how to make the expenditure numbers add up to upside potential like 6.7 or 6.8, 6.9, 7 for 2018, as opposed to a 6.3, 6.4 kind of, you know, directionally down kind of story.
Professor Xiang.
Upside surprise?
Huh?
Upside surprise?
Yeah, looking for, you know, what would happen in China that we'd see greater growth?
I believe upside surprise will occur at least in 3 sectors or 3 fields. First of all, just as mentioned by Dr. Liang, Huang, the new economy. And now, you know, investors are looking forward to several Chinese fintech as well as companies in new economy will go public very soon. And some investors also talk about when the market cap of Tencent, Alibaba will surpass market cap of Google as well as Apple. Sorry. So I think there will be a big surprise in the Chinese new economy. And second field, I think, is healthcare industry as well as entertainment. Entertainment industry in these years growing very, very fast. And of course, healthcare is in a very urgent and huge potential demand. So more and more investors plan to invest in healthcare industries. Third field, just mentioned by Dr. Qin, I think is infrastructure supported by governmental programs, particularly PPP. You know, even coast east areas, the infrastructure construction has been almost accomplished. But for, western area, southwestern area, northeastern area, there are huge demand for high-speed railway, subway, and many other, public facilities. So I think infrastructure will grow in very, very fast pace.
Terrific answers. You know, it's funny. I guess it's interesting when I'm a deal guy even though I've been president of the committee for a decade, I'm just a deal guy. I always go from the bottom up as opposed to the top down. And I expected answers like a bilateral investment treaty would open certain fields in certain sectors in China to investment, which might create a surge of GDP growth. I thought about a rethinking of China's monopoly views, that the Chinese government has a very broad view of what an appropriate monopoly is. And that, I think Economics 101, I was a lousy Economics 101 student, but I still think I remember, when you break up monopolies, you generally get more economic growth, that it creates a surge of investment, a surge of growth, and stuff like that would do it. I've been troubled by the party interference that is increasing in the private sector, especially in the new economy. And I believe that's affecting valuation of these private companies on the market, which of course has a wealth effect, makes people in China who own these shares feel poorer and they spend less money. And that a rethink, and this is a new direction. The Chinese policymakers, economic policymakers, are very smart and they're very well trained. And when they, somebody said earlier, I think it was somebody said, China does its economic policy by crossing a stream, by stepping on a stone. And when they step on the wrong stone, they generally recognize it fairly quickly, and they go and they put their foot on another stone. So my hope is that this party interference, which is clearly problematic, I think, for stock market valuations and ultimately for growth, would create a surge, an upside surprise in China. And I thought about, the capital controls are intended to affect outward investment. But as an old deal guy, I can tell you they affect inward investment, because you're worried. You don't invest because you're worried, can I get my money out when that day comes? So an announcement that capital controls are over, they've been a failed experiment. You can argue whether it has or it hasn't, but my view as an investor for 25 years, it's not a good thing, because it creates, I think we talked about capital distortions. It creates capital distortions and inefficient allocation of resources. So I thought those would be, from a deal guy's point of view, those are some of the upside potential in China. Let's talk about the U.S.-China relationship and what the risks are there. Dan, you want to kind of give the lay of the land politically? Because I think, you said, I think people don't have a realistic view of the risks here, and I think that's true.
Well, briefly, I think that neither side fully appreciates the perceptions on the other side. I think on the Chinese side, there is a very clear, rational analysis that it's simply not in the interest of the United States to trigger a trade war, or for that matter, a foreign direct investment reciprocity war either. That the economic benefits to the U.S. from the economic relationship are just too great. And powerful institutions like the New York Stock Exchange will surely lean in to the White House and prevent policy from going off the tracks. And yet, I think, as rational as that is, there are things happening on the U.S. side which are not normal in this regard, and maybe not even rational from an economic and markets perspective, which are taking things in a direction which are much more likely to lead to policies that will decouple our economies from one another, or certainly block the new opportunities for growth at the margin, like additional direct investment growth between us. Likewise, on the U.S. side, I think there are misperceptions about what's going on in China. It took the current administration the better part of the first year of the presidency to realize that currency manipulator really was not the issue. Just last night, of course, finally, I think Beijing stopped trying to, demonstrate, an effort to hold the value of the currency up against the dollar, and said, well, look, this is actually what happens if we don't intervene. Watch. And yesterday we saw a most significant downward movement of renminbi against dollar in a long while. I think it's a taste of what may be to come. So how do we bridge the gaps that have opened up? And we started this relationship 4 decades ago, Steve, when the committee played its formative role as a bridge by getting past misguided notions of what the other was. And that paid tremendous dividends to us all. We are back in a place now where the gaps are opening up on both sides, and those interested, invested in a solution are going to have to take risks and chances and step up and lean in, I think, or we're more than likely going to have something akin to a trade war by the end of this year.
Any of our Chinese colleagues want to comment?
I think in order to enhance mutual understanding, U.S. and China, and improve the relationship, U.S. and China, I think we must understand that definitely the two different models of economy as well as the society. What's the Chinese model? What's the new era just discussed by Professor Justin Yiping? What's the new era? New era is a new era of socialist with Chinese characteristics. What's the Chinese characteristics? Communist Party made it very clear. Chinese characteristics is Communist Party leadership, everything by Communist Party. That's the Chinese model we must understand. So US model is totally different because we have a totally different history, evolution of society. So we need mutual understanding. US, this country is unique. It's unique, you all know the history. China is also unique, so we must have our model. I remember the Economist saga, University of Chicago, Roland Coase once said, what's the Chinese model? Chinese model is Communist Party plus private property or private ownership. So under leadership of the Communist Party, we can create a new model with market dominating almost all sectors of economy, perhaps with exception of SOE. You remember last September, the Central Committee released a document with the State Council to encourage entrepreneurship in China. I think that's the first document in the world by a party to encourage entrepreneurship and to protect the rights of entrepreneurs. So I think if we understand the Chinese characteristics, we can have some emphasis or understanding of why China adopt such policies, such measures. For example, why Communist Party began to strengthen control of SOE in these years. Why we have a capital control, not capital control, we not use capital control, we use prudential management. And in this sense, I think many blames by US on China are misguided. For example, US always blame the trade deficits on China. But according to basic theory of international economics, US is a country issuing international currency, international reserve money. Any country issuing international reserve money must have balance sheet deficit, must have trade deficits. But which country create deficits? China emerging to become the biggest manufacturing sector. So it's a natural development of international monetary system, not blame China, you know, and sometimes U.S. also blame China is not market economy. Well, what's the criteria of economy? Any definition? There is consensus. There is consensus of market economy globally. So by U.S. definition, of course, there is a interference by party, by states. Yes, we are improving. We are trying to, for example, Premier Li Keqiang emphasize again and again, we must reduce interference of states on enterprises. So I think we need mutual understanding of the unique models of China and the U.S., which, you know, depends on unique histories of two countries.
Go ahead.
Just add a quick comment on what Dan said earlier on, the likelihood of a trade war between the two countries. I think he's probably right. We don't talk too much about the potential of a trade war between the two countries. But part of the reason, I guess, is I actually am surprised that a trade war hasn't taken place so far. As an economist, I waited from day one when Trump came to office, and I thought we should be prepared for a trade war. It's the fact that it hasn't happened. It tells me two things. Either, number one, because President Trump is a rational person, because he is a businessman and he can calculate. Number two, because the probability of a trade war is not determined by economic factors. If that's the case, then there's not much sense for me as an economist to talk too much about trade war, whether or not it will take place, not determined by economic factors. So I just want to add this point to say, not because we completely ignore the risk of a trade war, but the probability of it and the potential damage of it really beyond what me as an economist could comprehend. But I certainly would support him that this is a high-risk event, and we should all pay attention to, especially in the coming year.
I want to open the floor to the audience and just ask one question, which probably nobody is going to want to answer, which is, what risk does both corruption and the corruption crackdown pose to the Chinese economy?
I thought that's one of the things. A lot of people then were saying, how could we see growth being stronger this year? I think I talked about some painful adjustment that happened in the last 3-4 years, but there's a positive side that nobody write explicitly. I think if we think about corruption tax in China, it should have come down significantly in the last 4 or 5 years. The direct, immediate beneficiary of that should be consumers. That's part of the reason why consumption held up so well in volume terms. But secondly, I don't agree with Dan when he said business investment will come down. Haizhou just commented in the last session, Hong Kong stock market gained 36% last year. For what reason? Because a lot of companies, the Chinese companies, made wonderful returns. The ROE of Chinese non-financial companies have come back to above 10%, way above cost of capital. And they started to invest, both the new economy and the old economy. I think corruption tax coming down will be a much meaningful tailwind when companies started to do investment, despite some of the so-called party influence. But I don't see any emerging market has such less red tape as in China now. When you want to have a business license, when you go to a government agency, a lot of provinces are trying this one window, you get all your license and paper done process. Again, I think corruption is a big issue for both emerging and developed countries these days. But I think China using probably their way, it can be brutal sometimes, but it cleansing up the system quite thoroughly, even if it's temporarily, for a couple of years. I think that's a great thing.
Does anybody but me worry about corruption in public contracting, creating what potentially could be a black swan event, where if you go back to the earthquake in Sichuan, we saw the public buildings collapsed and the private buildings remained standing by and large because the corruption had seeped into the public building. They weren't built to code, and when the earthquake hit, they collapsed. And in my nightmares, I always extrapolate that to petrochemical plants, to nuclear power plants, to other things which are not built to code, and therefore something goes wrong and it creates this Massive tragedy. Am I the only person? Does the Chinese government worry about that?
Government should worry about that. And as I said, corruption is not just in China. I think that's probably the public resentment to a lot of governments everywhere. So, for example, we have heard infrastructure corruption cases even in Hong Kong. So that big bridge, the side that gets very corrupted is not actually on the mainland side. A lot of other public work cases as well. I'm not defending any of them. I think for China, it was always a risk, but I think how Chinese government survived is because the general public feels is the little bureaucrats that are the sinners, and the emperor is always good, has a good intention. But I also think the last 3-4 years, I think this is probably a general public has not realized that anti-corruption campaign has won so much goodwill for this new administration. The liberal intellectuals probably are not very happy with certain control measures being tightened, but I think widening out corruption, even if it's just temporarily, has gone a long way to win back some of the credibility for the government.
I just want to second that, and it's even much bigger than just anti-corruption, right? I mean, so much of the miracle of Chinese growth the past 4 decades was government stepping out of the way and letting private people, green light meant go, red light meant go around, and then keep going, right? That was the wellspring of Chinese growth, turning your head away, not looking at environmental problems, not looking at labor market issues and protection of workers, safety issues, not looking at subsidies and protection and what the cost really was. We'll worry about that later. As Professor Lin said, later arrived on the 3rd plenum of the 18th Party Congress. Now that's underway. But this is when a country gets to this income level, instead of government turning a blind eye being good for growth, it becomes bad. Because people have become so wealthy, and the nature of tomorrow's economic growth becomes more complicated. It needs a legal system. It needs regulators who are fair and who make the rules known in advance so people can plan efficiently how to use other people's money that is paying for the next round of growth and all that. And so the rise of the regulatory state doesn't need government to give all the power away from Beijing to the provinces. Quite the opposite. It needs exactly what the party has done the past 5 years, consolidating power to Beijing, becoming a much stronger government, not just a party, but a government that can provide a regulatory structure in which healthy economic activity can happen. Anti-corruption is just part of that. So the problem is not a strong center in China and a strong Xi Jinping for that matter, or even a strong party. The question is, what does it do with the power? Is it pursuing the what I would call reform objectives? Maybe there's disagreement about what the model should be, what power should be used to try to get to is the question mark that we debate up here. But I think generally we agree, and my liberal American friends don't like it when I say, I understand Xi Jinping's consolidation of power. What other major country can be run with a committee where everybody has an equal place? We needed a strong center in the Standing Committee of the Politburo of the Communist Party of China. This makes sense to me as one American. I'm not opposed to the basic picture of what we've seen happen.
Let me open the floor to questions, and we're going to use some of our closing time for this panel. So go ahead right here in the... Yeah.
I have 2 questions, one for Daniel, the other for Professor Huang. So for Daniel, in terms of CICC, after Trump's visit and his tax reform, how do you think, what will be the influence for the Chinese companies' M&A deals? And for Professor Huang, you mentioned the risk from high leverage of the Chinese company, their corporate bonds. How do you evaluate the risk from the local government financing vehicles bond, the 城投债? And because there are invisible from the balance sheet? Thank you.
The two big factors affecting the flow of Chinese direct investment into the United States. Number one is Chinese capital controls, or whatever you want to call them. That was 80% of the story in 2017. China decided it needed to deal with problematic 有问题的 flows, so then capital leaving the country in certain sectors. Some of the sectors that everybody's excited about inside China, like entertainment, apparently are bad news when companies leave China. Well, then there's the inflow side, but I just want to say things that are okay in China, like entertainment sector, are suddenly become bad when companies go abroad and invest in the same industries. But the other factor, in addition to those capital controls to manage the balance of payments, was Chinese security screening, which is U.S. security screening, which has been raised informally a lot already. And now we're going through a legal debate in our legislature, which will probably result in changes to our CFIUS process, which is how we screen inward investment. But I would just finish with this. The United States could double how high our barrier is for national security screening, and there would still be room to increase Chinese FDI in America by 4, 5, maybe 10 times. There's not a choice between security and commercial flows. The vast majority of Chinese interest in being in this economy has nothing to do with national security, and it will not be prevented or stopped or impeded.
I think broadly defined local government borrowing is one of the biggest potential risks, financial risks. Not so much about the borrowing stocks, how much they already borrowed. The problem, I think, is number one, it's not very transparent, and number two, often the responsibility is not symmetric. That's why the investment vehicles you mentioned earlier, sometimes they borrow as an independent corporation, but it's directly or indirectly linked to local government. So one thing you find is every 2-3 years, the central government will do a survey about how much the local government's borrowing altogether. Every time the number just goes up. Which means the local government's been very creative, innovative in finding ways of raising funds to support whatever they want to do. So I do think that's one of the biggest risks in the system. But you probably also noticed that the authority is trying to figure out how to sort out this mess. And one of the things they're doing is trying to, number one, to stop the borrowing, the reckless borrowing by themselves, and number two, make it more explicit, the balance sheet of a local government, how much assets you have and how much you might be able to borrow. In the end, I think one option is let the market determine how much you are able to borrow and on what terms. The third measure the government just adopted is some kind of a responsibility system. If a local official that decided to borrow for the local government, if once there's any problem, that official might have to take lifetime responsibility. I don't know how it will work out in the end, but this shows the determination by the central authority to sort out this big mess.
Michael Enright, University of Hong Kong. What about the risk of hubris? We now clearly have the flip side, perhaps, of what Dan was talking about. We now have, a very strong unified leader. We have a standing committee which seems to be chosen as much for ideology as for individual capability. We have major initiatives such as One Belt, One Road, which is a very expensive undertaking, and foreigners are not stepping up to finance, but it has to succeed, so it has to go ahead. We have internet programs and policies that Dan has written about that could isolate China and cost trillions of dollars worth of GDP. We have Manufacturing 2025, which either will make China the world's most advanced manufacturing economy, or it will isolate China from the cutting-edge ideas from foreign companies. We have a payment system which is all stuffed up, and we do have financial. Because risk, again, one of the things I do for a living is risk management. Risk events, everybody looks at risks and they look at individual items. That's never the way it happens. The way it happens is you have an underlying cause and then a whole bunch of things that are connected. And if we have that combined with a bureaucracy that's frozen because they're waiting for Mr. Xi in Beijing to make decisions, to me, that is the most reasonable risk scenario, and I just wondered if the panel would comment.
Actually, that's why I singled risk in the financial sector, and particularly when it comes to open up a capital account, because that decision requires a very quick, acknowledged decision making, and we have seen them in the past making very lousy decisions on that. But things you talked about, as long as it takes some time, and I think if we compare, sorry to say this, but if we compare decision making in the major countries, I think actually China is not bad at all in figuring things out, as maybe Nick said. Let's say even during a trade war, during some of the issues, I think if you give them some time, the Chinese seems to be able to calculate well, and they also seems to be able to take hard decisions. But I think financial issues, decisions that need a quick response, is their weakest point.
Again, thank you for such a wonderful program. Every year, I always look forward to January being here. With crisis abound, with so much conflicts potentially, sure, there are plenty of risks and opportunities. We talk about many potential wars, trade wars, nuclear wars, you name it. What about currency? Now here, I'm not only talking about the globalization of RMB, it is a blockchain, cryptocurrencies. Now, I read it somewhere that Bank of China, or maybe it's fake news, are really now getting ready to issue cryptocurrencies. So how is it going to affect us and so forth and so on? And, so I have more questions, but I'm going to restrain myself to only stay with one. Thank you.
You mentioned the People's Bank of China, not the Bank of China, right? Number one, Bitcoin the trading is not legal in China. So whatever the central bank is talking about, the digital currency, it's a sovereign currency, and everything else. We don't know exactly how it would look like yet. PBOC has a new institute looking into this area. They're very actively trying to create one for China. But my wildest guess is it will be a very similar internet version of RMB. It's not anything like the Bitcoin. Well, how will it affect you? In the near term, not much, I guess, because the currency is not convertible. But over time, it could, once it becomes internationalized, it could actually facilitate cross-border transactions, and I think could potentially significantly increase efficiency. But these are all very uncertain at the moment. What I can only say is that to my very limited understanding, PBOC is at the front among the central banks trying to create this new digital currency. But again, it's not about another Bitcoin, it's another RMB.
I'm curious what our Chinese colleagues think. In around mid-year, we have the next step in MSCI opening. Should one of our upside expectations for 2018 that despite all these complicated things we're talking about, institutional investors are just waiting for the right time to increase their position, long China position. And it matches very much with China's desire to broaden and diversify capital investment through the Chinese economy to mix other kinds of capital into the investment already there. I'm curious what my colleagues think.
We actually have seen in the past 1 year increased interest in Chinese equity and also bonds. With the Stock Connect and Bond Connect through Hong Kong, you can see the volume, both the turnover as well as the holding has increased substantially and consistently. I think that is driven by fundamentally people are short of RMB assets. China's economy is 15% of the world. Allocation to China, 2%. Bond or equity. The Chinese need to allocate outside of RMB, but the rest of the world needs to allocate in China. I think that's fundamental reason. But secondly, the companies are doing wonderfully well. And this is one of the major equity market that is still very cheap and still significantly underweighted by most investors because people were 2016 expecting China to hard landing, 2017 expect China to slow down. This year, everybody continue to expect it to slow down. So the bar is very low. And I think my 7% is very conservative. I just think when everyone raising every major economy's growth forecast for this year to this side and said China is the exception, that doesn't work in a globalized world. And Trump has not staged a trade war yet.
Yiping, any final words? You have closing?
Oh, I forgot. Because this
It says
is
on the
usually,
agenda here. Closing remarks, Huang Yiping, Stephen A. Orlins.
Liang's job, but he can't be here for health reason. Anyway, so time goes fast, and I like to thank everybody here, particularly the New York Stock Exchange for providing this wonderful place again. And I'd like to thank Stephen Ring for the National Committee for doing this with us many years now, and I hope to do again. And I also like to thank my colleagues from Beijing. They traveled really very far away, not only to do this, but this is a very important part of our program. And finally, I like to thank the audience for staying here for the whole morning. I hope you enjoyed this discussion as much as I have done. But please, if you feel this is a good event, then please come back again next year. But most importantly, most of my colleagues, they're all very well known, not only internationally, but also domestically. So if you're interested in their views, you can always follow them. So thanks again, and wish you all best of luck for the rest of 2018.
Thank you. And